All right, welcome to 2024, folks. This is the office hours where we go over, some of the new opportunities that are coming up, and it allows, some of you guys who are new to our group, allows you guys to kind of ask in a semi-private format what, some of these tax strategies, or any other investment kind of, new person questions. We get it. A lot of the stuff is new to you guys, especially when you're starting out, and especially being the beginning of the year. I think it's a good time to kind of for people to kind of glean from other people's questions. So as far as deal flow coming up, we've got the taxpile fund, although I do think that a lot of people aren't really going to be super interested in it until we get into the second half of the year. There was a big rush into it before last month, getting in, your 2023 passive activity losses for that particular one. But I think people don't worry about taxes until you get to the crunch time at the end, and part of it naturally, so you kind of know what you're selling that year, what your passive activity loss time horizon needs are, and then I think the first half of the year where we're at, a lot of people, if they haven't yet, they're trying to figure out how to implement real estate professionals status on their own. And part of that is, maybe what might be more make more sense to kind of put out there is like, this is the time to be looking for your CPA, and also your legal team. If you guys need a referral, please reach out, team@thewealthelevator.com. There's been a lot of kind of movement in, people we've been using. As what I've kind of noticed, a lot of these guys, the pricing has gone way up in terms of the service. And as you guys know, that is called value. The value for the money that you get, or what's the saying? The saying is, the price is what you pay, the value is what you get. So, there's been some movement there. So I think most of our clients, especially coming in, the CPAs that they currently work with, they just they're just not very good, right? They just don't understand the concept of using passive losses to offset passive income, and let alone, what the heck real estate professional status strategy is. So, I guess for starters, get yourself set up now. Don't wait till March, April, because that's when they're super busy doing corporate returns and everybody's personal returns. That's not the time to be doing your legwork. So for some of you guys who wait to the last second, don't do that. Interview your guys now and get set up, and figure out if you can make a run for real estate professional status, because then it opens up this big horizon to now use these passive losses to offset other income there. So one thing I did do a video the other day. I'll share my screen here. The tax brackets have slightly changed per tax brackets have slightly changed per the inflation. As you can see, last year, the magic number for Marifel jointly went from $364,000, and now it's $383,000. I don't think that's a surprise to anybody, but my general thoughts is, if you're above this red line, you really need to be thinking of some kind of alternative tax mitigation strategy, and using rep status with some Section 179 deductions can be a great way of doing this. And we've got actually a nice big crowd here today, live crowd. We do this every first Saturday of the month. If any of you guys have any specific personal questions on this or anything else, feel free to type it into Q&A, and we'll try to get to it, as this is kind of made as a time for those of you guys brave enough to come on here, ask a question for a friend or for yourself. So getting back to deal flow. So as far as commercial real estate has been speed up, right, over the last 18 months. Prices have come down, let's just call it 20-30% across the country. It's not like a regional thing. It's a national thing because interest rates went up. And because the interest rates went up, you have the capital markets, the lenders not really lending to the same standards that they were. So the way that's played out in the commercial world is you're not able to get as high leverage as you once were. Previously you're able to get maybe 70% loan to value, loan to cost, but nowadays that has gone way, way down to maybe even under 50%, meaning that you have to come with 50% of the deal, which is why we haven't really bought any of those types of projects since summer of 2022. So well over a year ago. Now, residential, the way that plays out in residential, you just see the interest rate go up. I think the interest rates must be in the high 7%, maybe even 8% today, which is why, the buyers aren't buying. And in the same, different reasons, but same result in commercial real estate, the buyers aren't buying, which is why the prices have come down. Now, in the residential world, you don't see that price drop because part of the interesting dynamics, and part of this is all supply and demand. In the residential world, you have a lot of people stuck in their current mortgages, happily at like a very low rate, so they're not moving. So you don't have that supply on the market, and days on market in the residential world is very low, which is why that prices are still kind of propped up. I don't know. I don't really know, nor do I really care what's happening in the residential world. I'm more on the commercial side, but in the commercial side, yeah, you're seeing this big discount of properties. So from the one hand, what some people are doing out there, they're going on this narrative of like, they're going to pick up some great deals. And from one side of the equation, yeah, they are good deals because you could be picking it up for like a 30% discount, maybe even more. However, the way I look at it, again, why we haven't really been picked up deals, if the debt side of the equation doesn't work and I have to bring in so much more money to the table, even paying a lower purchase price, it's still what is the return on investment at the end of the day? And that's where I'm saying it's still not penciling. But there's a lot of, shakeups, right? Like a lot of, syndicators are belly up. Like I've seen a lot of guys like who were in the business that are no longer there here, going to get day jobs. And we'll be around, right? We've done $2 billion of assets. There's been, we're not immune to this at all. A lot of lessons learned, obviously. But the majority of the portfolio is intact and will survive to make it past 2025, 26 and make a great return. And we will be around as an investor group. So what you're seeing, I think, is a big clearing. And in the midst of this, I think especially this next year, it does create some space for some newer syndicators who are wet behind the years. I don't know if I want to use that kind of old school analogy, but maybe because I'm getting like 40 and I'm getting kind of one of the old people in a way. And they're going off of like, they need to take some chances, as I did at one time. So they're kind of going in saying, yeah, let's go in with these more aggressive types of distressed deals. And that, I think personally, maybe I just overlay where I am at in my personal wealth building journey and life, where I just want a little bit more security and I don't really need nor want to take chances. So I'm probably going to hold off on doing that type of, more distress investing until maybe even next year. Who knows? What I do know is in 2024, I am going to be focusing more on more conservative deals. It may not double money in 5 years. In fact, it probably won't, but it's very secure, more, less value add, more, think of it like triple nets, right? Or land royalties, something that's a lot more secure, something I can sleep well at night personally. And I get it. Some investors, you guys may want to, go in now when there's, there's likely to be the bounce off the bottom. I mean, it now may not be the bottom, but I think long term, you're gonna look back at right now and you're like, dang, I should have got in at this point, made this a great entry point. But do you dive in, or do you kind of gingerly kind of dip your toe in into more secure types of investment arrangements? That's kind of the what I'm thinking in my head. And part of this is just like taking a step back and, how did I personally get here? Investing back in 2009 and just ton of dollar cost averaging my way into this. It wasn't, going after value add initially, right? It was just a lot of buy and holds myself. So I see it as just, we had a great bull run for like a decade, and um, just get back to the basics. Let's just repeat the way we got here and go in slowly and dollar cost average and kind of, going in these more secure deals. So you guys, but I want to know what you guys think too. So we have the survey that we're circulating. If you guys haven't done it yet, please send our team an email for you guys to fill it out. We usually get, at least 100 people putting our input in that. So we get some pretty good data, what you guys are looking at. And one of the key questions is, do you guys want to go in aggressively into those more distressed types of deals where there may be some a little bit more hair on those kind of, projects? Great returns, like amazing returns, don't get me wrong, or potential amazing returns? Or do you kind of want to just play it safe? Like, make a great return. And if the market, the market rises, then you get a part of that too. But, let me know what you guys are thinking, because, another thing that I've seen a lot of investors will do is you guys still have your stocks holdings and you guys want to diversify, and you guys see the projects that we'll do as more of the asymmetric plays part of your portfolio. And maybe you do want the super aggressive stuff because you can't really emulate that within your traditional investment portfolio. Now, some other people have, like myself, gone majority of your holdings into this alternative investment space, and therefore you would want more of that conservative type of prospectus. So, it's just it's more, it's kind of a couple of questions. What do you want? And then you also have to overlay like how does it fit within your personal portfolio? And this is where it gets into more personal finance and kind of it really, you tell me what you guys want, I guess, is what I'm trying to say here. Let me. So if you guys can help me out, do the survey. It's in the emails there, the link. If you guys don't have it, just reply back and we'll send you guys the survey link. We'll probably do a future, probably next month, we'll probably do the results of that survey, just so you guys know what other investors are kind of thinking about, what's in their head. I kind of think maybe it doesn't matter what your peers think, but just a data point out there that we can kind of provide what's other people in this space are kind of thinking out there. But yeah, we'll get into some of these questions that you guys have submitted. Let me try something new here. I'm gonna try, and you guys have sent these questions in by typing it, but let me see if I can.
I stopped telling people exactly what to do with their investments.
Right, so that's the question. So, I think what I realize is there's a big layer to personal finance to this type of stuff. Like, I may like a deal, but I'm looking at from a lens of how it fits within my portfolio. It's somewhere I think buried in the e-course, which I think if you guys sign up, you guys should get access to it. I had this big scatter chart of, deals that were more value add, more development, more, and then on the other end of the spectrum, more yield type of plays. And then also on the other axis was, location wise where they are. And it was, not saying it was the best way, but it was a way of kind of mind mapping, the risk reward and diversifying your portfolio, at least on the alternative investment space. And what I guess to my earlier point, what I was mentioning earlier, you may be an investor who has all alternative investments, and therefore then you should really diversify in all these types, in this manner. But if you're an investor who has still 90% of your portfolio in stocks, bonds, mutual funds, and real estate is more of your conservative play, or maybe it might be the opposite. It might be you might want to be more on the aggressive side, right? Like I don't know that. And unless you guys do like a paid coaching call and you complete the full personal financial sheet and you list all your holdings, I don't have a slightest clue on what you're investing in, what your portfolio is. And even then, I need to ask you where your head is at, what you're looking for. So that's why, this is several years ago, and I stopped giving people advice. But if you guys really want it, I'll caveat saying, hey, here's, two things. I'll tell you what I would personally do because I have the confidence and kind of know where to put my money where I don't can avoid the counterparty risk. And the second thing I'll tell you is like, here's what I think you're going to do, because there's a certain, path that I think that we have well over 800 investors that have invested us with in the past. I don't tell them what to do, but I observe what they do. And I have some good insight into that. And I write about this in the new book. Most people will start out with 10 to 20% of their net worth into this types of alternative investments, see how it goes in the first several years, really trying to check the box on like the counterparty risk side. Is the people I'm working with, are they conscientious? Are they not stealing my money? That's a big part of it. I mean, that's how I kind of got burned when I first started to do this back in 2016, 17. And I think that's something where we're going to head off more in the future, bringing on more of a underwriting staff and, other investment officers to expand the investment committee is kind of the next path forward. And kind of do it more in a fund of funds model where we're all kind of investing together and kind of I'm there to kind of lead the charge if anything kind of goes south. At least to expand to different, real estate sectors if needed. But that's a long story short, like, why I stopped telling people exactly what to do, because I just don't know what's in your guys' individual portfolios. Here's the next question.
Shift towards being more hands-on investment approach.
Yeah, so a little bit of history of our investment group. So in the very early stages of our investment group, I would be going into deals, and a lot of times, when we first started, we wouldn't have the best deal flow or network. And maybe some people don't realize, but there's a lot of like educational groups out there that teach people how to be general partners. A lot of those groups have just been like, throwing a grenade in them in the past years. It's a little bit of a scatter nowadays, but like, people would go here, they would teach people how to underwrite deals, and they would teach people how to market themselves as capital raisers and general partners. I actually, looking back, it was kind of stupid. Like they teach people more about taking selfies and doing stupid social media, like, the thing where they walk and they talk and like promote themselves, and then actually operating the asset. And like I call this kind of the fake it till you make it network. And admittedly, we were there at one time, right, when we first started. And this is kind of where I did make mistakes, investing with some of the wrong people. people who supposedly had the track record, but they didn't, or they just didn't have the competency to kind of carry over to success at the end of the day. That in my earlier days doing these syndications, maybe 1 out of 5 people we worked with just weren't, great operators. And but part of that was, as the mature network we were at the time, we weren't writing big check sizes, where we weren't able to get access to better operators. And that was kind of where it's been a slow climb up to this point. Early on, I got kind of burned, like I said, and that was kind of where I decided as a group that we needed to be more of the exclusive capital source for our partnerships, and in a way get married up and be part of the operation ourselves. That actually turned to be pretty successful. We actually just sold a property very recently where I forget what the numbers were, but I think we bought it for 9 million. We sold it for like 14, 15, something like that. But it's essentially a successful deal, right? Amongst a very difficult, depressed market in 2023. But what I'm realizing, and there's always a growth process in this, and is, my portfolio has gotten pretty heavy, 90% in like multifamily apartments. And, I think some of the things, listening to the investors here on these types of calls and like the survey, again, do the survey, guys, is, there are other asset classes out there within the world of real estate, maybe even outside of the world of real estate, that, we should explore. Right now, for example, commercial real estate, especially in the sectors of multifamily and office, it's kind of going, it kind of went through a big loss. Now's a good time to actually be getting in, right? Because there's been that correction that happened last year. I still think that there's maybe another quarter at least of fallout, and which is again another reason why I'm a little hesitant to kind of go in at this point in that certain asset class and business plan. But yeah, I think I've actually started to join other investment groups outside of real estate. So I don't think, like venture capital. I've joined the local venture angel group here, and then started to explore e-commerce, SaaS business operators. I've talked to some of the aggregators. For those of you who don't know, like the e-commerce SaaS business, like they had a much bigger meltdown than real estate. In 2017 to 2021, a lot of the aggregators came in, which is another word for private equity. They came in, gobbled up a lot of these successful operators, thinking that they would take the deal to the business to the next level, but where it's just the interest rates kind of killed it, and interest rates really do impact real estate and a lot of other businesses and asset classes out there. And a lot of these e-commerce types of businesses kind of fell. Part of it too, I think, after post-COVID, when everybody kind of wasn't shopping online all the time, and that was another reason, to add to that double whammy. But now's the time, especially in e-commerce, where you would think that there's distress in the market. This is the time to make acquisitions, right? Well, sellers are desperate. And I think that's what separates the unsophisticated investor who invests in the late cycle, in the frothy 2021, 2022. And, and this is just me intellectually trying to guide my behavior, right? Look for the places where things are quiet. Not a lot of people are talking about it. And the frenzy and potentially fear is there. Fear is what creates buying opportunities. Just another example, like, I'm not a big fan of crypto. I like the idea of it, but I personally don't really like how it's not like a real tangible asset, and especially how it doesn't provide value to users in the world, and how you can't value add crypto. But crypto's off the highs and it had its correction. And the other nice ingredient I see is nobody's talking about it, right? You had the big FTX fallout. I know people are still trying to get their money from BlockFi, um, and the Celsius, but you want to invest in things when the frenzy and froth isn't necessarily there, and that is now for that, and now for real estate in a way. But yeah, in the future, yeah, definitely kind of looking to expand, other investment avenues, um, data centers. I was talking to a guy yesterday. Um, I think another key element of this is, the capital markets, getting your debt products, getting loans is going to be difficult the next year or two. Interest rates aren't going to be coming down right away, and long term, they'll probably stay around that nice 2 or 3% Fed level, meaning it's not going to be the end of the era of free money is essentially over at that point. So some people see it as the game has changed. And I take that idea away from Howard Marks, who's a very respected investor, probably the next generation Warren Buffett, as if you want to kind of follow another guy out there. But there's been a kind of a changing of the guards recently where we're not in a world of free money, and you're going to need to find yield in the next maybe 6 months. You can't just sit on your butt and invest in T-bills. I actually don't think you can even do that now. And you're probably better off putting it in your life insurance, making money there, litigation free on that stuff. But you're probably, you're gonna have to find alpha is the term that's said a lot in our world. And where you're gonna find it. It's not gonna be just simply buying any piece of real estate and adding a nice, easy, cheap loan to it. You're going to have to add value to it at the end of the day, whether that's buying a brick and mortar business, whether that's a plumbing company or HVAC company, an e-commerce business, or building an apartment from scratch, right? Developing, right? That's what I know long term is what's going to create wealth is when you add value to an asset. So I know that's kind of esoteric, but as an investor, those are the kind of, I think that are the time tested basics of this. Some people believe in buy low, sell high, but that requires an element of luck in that. Guys have some of you guys are new here. If you guys have any Oh, Robert, Mark, do you want to come off mute and ask a question? See you guys there. Sorry, I'm just digging through my question box here. Here's a tax question.
What's the difference between business CPAs and personal tax experts?
Yeah, so I guess some of our investors are business owners. So like dentists or any other business owner, they'll use their business CPA to do their personal taxes. I personally think that it's two different worlds. And often you don't want to have the same one because if they're good at one, they're likely not good at the other. So the business CPA is the one more working like with P&Ls and more on the business tax side. Whereas the personal tax side, I think you actually need to get more creative on the personal tax side and using all these different strategies that we kind of talk about. But if you're using the same person for both, I would kind of urge you to kind of change that up. We actually do have a webinar next week, the 8th. Yeah, let me double check. Yeah, Tuesday the 9th, where you guys get to ask questions to a CPA. So, the questions that are up for grabs are like, should I use an LLC? Is this scenario work for my rep status? I'm selling this property. What is the tax implications of this? So it's kind of it's a fun time where you guys get to kind of ask questions of a real CPA, not just me kind of playing one on a podcast, but you can kind of hear it explained a different way too. Because I think that's what a lot of this, when I was learning it, I had to hear it from different people in different ways, and then something just clicks after a while. And if you're a newer investor, a lot of this may sound very, very advanced. And I would say it's not super advanced. It's new. And once you get a bearing and you kind of understand a little bit, it'll start to become very familiar, I think. Of course, there are always kind of the details that kind of change behind the scenes, and that's where you want to work with a good CPA. But my goal for everybody here is, from a high level how things should work, so you can kind of spot check it and guide your CPA the right way, and then also, kind of get to the same numbers that they do at the end of the day, or generally speaking. So if you guys are using the same CPA on both your business side and your personal side, don't do that. But if you guys are, just working W-2 jobs and you have a few rental properties, yeah, that's totally fine. We're talking more for like the business owner who has employees and, those operational expenses that needs to be separate. Okay, so yeah, there was a question asked about, how does this kind of look big picture, right? Like if I invest X, how does that turn in years later? Well, if you're looking at myopically at one deal, that's where you got to look at your individual deal projections. For the most part, development deals make a little bit higher return. Maybe you can double your money in 3-5 years. Maybe you can get even more money than that. Lower value add types of projects where you're just trying to bump the net operating income 20%, you could still double your money, maybe in like a 5-year period. But these are just projections, right? In most cases, the last 10 out of, or 11 out of 12 years, we saw a bit of a cap rates coming down scenario, not hugely, but very steadily. And that's a very advantageous market to be investing in. And I would probably say that's kind of like sailing your sailboat with, a nice 2-mile, 3-mile per hour breeze behind you. Every once in a while, you have market corrections, and that's what we saw in 2022 going into 2023, where instead of that nice 2-3 mile per hour breeze behind you, you have a 10-mile per hour, 50-mile per hour gust in front of you for the time being. And that's just how it works. I'm not going to tell anybody here that you're going to make money 100% of the time. that is illegal on my part, and that is not the truth. And this is kind of where I'm looking at myself and more experienced investors, and the people who make it through from a portfolio standpoint are the people who dollar cost average and have deals spending more than 3, 4, 5 years. And because you don't know what's going to happen in 1 year, sure, maybe 90% of the time a black swan event won't happen. Shoot, maybe if it's even more, right? I mean, if you saw the last 11 out of 12 years were great. And I think that what's tough about like alternative investing, and I'd say this is the one thing, I do think it's a moot point though, but the one nice thing about like stocks is it never goes down to zero on an individual basis. Sure, like in 2020 and 2009 or 8, for those people who remember that, I myself was there, you lost a huge chunk of your portfolio. Where in some cases, when you break up your portfolio into 50 grand here, 100 grand here, when you're in, the deals that you entered in late cycle, you may have to kind of amputate off to save the body. Portfolio wise, again, to my earlier point, you have to diversify over a longer period of time. And then those deals that are seasoned in there, maybe even exited and made a bunch of money, they're pretty much immune and protected. And I think that point you need to, well, I'm kind of negating that my earlier point, is that you need to look at it from a more portfolio standpoint. Sure, maybe a couple of deals on this end acquired lately are gone, but you really should be, it's kind of your personal responsibility to diversify so that you have deals that are seasoned and kind of safe. And the only way you're going to do that is diversification. But that's the kind of the problem, I think, especially for newer investors, you have to have an entry point at some point. You're going to be exposed at some point. You're going to be that little vulnerable sea turtle making its way out to the ocean when the birds and the seagulls are trying to get you. And I was there at one time. I was lucky enough to kind of invest well before kind of the correction happened. But moving forward, the correction happened, folks. This is actually a nice time to be making a great entry point. Come in slowly. Like I said, I think a great entry point may be 10 to 50% of your net worth into the stuff in the first several years to kind of dip your toe in and to build that bridge of diversification. Because if you don't do it now, when are you going to be the guy who came in 2021, 2022, who was at the top? And in the same respect, are you still the same guy who's going to come in 2025, 2027, right, at the next top? There are market cycles. Typically, they're a lot shorter than what this last one was. This was pretty unprecedented, where the market cycle went on for so long. And in that respect, there is no natural market cycle, right? I think we've gotten off this stage where you can expect normal 6 to 7 year peak to trough cycles, because we're not feeding the garden natural fertilizer anymore. In a way, we're feeding it like steroids and artificial fertilizer. And what I'm citing specifically is the Fed and the government greatly manipulate the money system and what happens out there. So you can't, we've gone away from a normal market cycle, and we're into this now world of artificial manipulation of the markets. And some would say that happened after we went off the gold standard in, I think, the 80s. But certainly the case now. And that's why some people say, well, like, you just never know. It could be, like 2020 could have been like the correction year. But then the pandemic, with it pumping trillions of dollars into there, kind of saved everything and delayed that correction from happening, which is exactly what we saw. It's a kind of an understanding of like we've gotten off. This is kind of, I'm citing a lot of the teachings from Richard Duncan, who's, if you haven't subscribed to his newsletter, I think it's a few $100 a year. but he talks a lot about this concept of creditism. You know, a lot of people out there on these like doom and gloom forums will say, you know, like, how can we keep borrowing money? You know, look at the debt. It keeps going up. And yeah, like, dude, people have been using that narrative for the longest time. In a way, it's if you follow Richard Duncan's criticism idea, that doesn't really apply anymore. You know, and the whole narrative of like per percentage of GDP of that debt is, it doesn't really apply if the United States, who owns the best military and the biggest bully in the world, can just print money. It's more who controls the money supply. So there's different chains of thoughts out there, right? And what we do know is the game changes. And if you believe that, then the narrative of so much debt in the system, the government debt, doesn't really matter anymore. In a way, we're living in a world without gravity. And that's where I again, I kind of said this earlier, but if it's a changing world, what are the principles that still apply, right? Investing in solid areas. And this is kind of why we're kind of targeting some of these more, you know, places that we wouldn't target in my last 5 years of investing, more well-known low cap markets, to give you guys a little bit of an insight there, because they're a lot more stable and they're not like a smaller tertiary or tertiary market, or even a smaller secondary market. So yeah, just kind of want to put that out there. Like, I think it's a changing world. I mean, I think this is what separates the good investors from your average retail investors who kind of just go with what the masses do. And if you do that, you know what's going to happen, right? It's going to take 30, 40 years to retire and investing in the traditional investments. And that's kind of where I keep falling back to this trifecta of investing in good deals with people who are trustworthy, and you getting the tax benefits there to cut the drag on your net worth growth there, cut the friction, and, you know, implement some infinite banking, accredited investor banking for some of you guys who have some larger tranches and not looking to do a big, longer commitment there. That's what the accredited investor banking is, to kind of flash fund your policy in 1 or 2 years, as opposed to doing like a 6, 7 year, 10-year pay program and setting yourself up with that commitment. Changing landscape, of course. But yeah, getting back to the guiding principles, I do believe it's like you buy an asset that you think is at value or undervalued, and you improve it. And that requires capital, that requires expertise. And if you keep doing that, rinse, wash, repeat, you should come out better than the ups and downs of the market. And it's kind of like you live life off of more values than, at least I've been trying to live life more off of values than just strictly like what is the outcome. So what I mean by that is, like, you know, I guess the way my parents brought me up, and the operating system I was kind of originally brought up is like, you will get a job, you will get an X salary. When you get that job, you will hit your scorecard marks. Whereas, and that's outcome based, you know, governing. Where what I'm saying is, what I'm trying to live life more by is by values, right? Treating people with honor and respect, do what's right. Even if the outcome isn't very good, you know, you put your head down and keep working the process if the process is sound. And part of this is just continue to add value and, you know, buy things that make sense. And, you know, when the time is right, to sell it for a good price. And at the end of the day, you know, I've seen some operators commit suicide, you know, and you know, maybe because of it, because they were too much outcome based goals. And when you're more value based, I think you tend to be happier, and sometimes you tend to get a renewed source of motivation, and you ingrain yourself in working the process more, which is really what you should be focusing on, than getting up and down with what is happening outside of your control. So yeah, I mean, that's just kind of some thoughts lately in terms of, governing off of values instead off of, the short-term goals. And I think that's where investors need to kind of go back. And I think this is what kind of sharpshoots traditional investments. I mean, sure, the company is doing what they're doing to grow the company, but a lot of that money is going to the staff and CEO and top of the line costs that don't flow down to the investors putting the skin in the game. And there's all these kind of hidden fees in there. And I think that's where the alternative investment path kind of comes into play, where you get, you're putting skin in the game, so you should get the upside and rewards too. We got getting up to the top of the hour here, and we got a couple more.
How should accredited investors approach their investment decisions?
So what I would start with is like where you are in terms of net worth. So and this is the concept that's in the Wealth Elevator book that should finally release in February. But it depends on where you are in terms of net worth, and I guess more specifically where you are in terms of your end game number. So for some of the clients, that number may be 4 to 5 million net worth, where they're able to draw 10, 15, $20,000 of passive income off of that at a pretty conservative low rate of return of 4 to 5%. For some investors, and I've talked to a couple of these guys recently that live in a lot lower cost of living areas in not Central America, but the Central US. But they and their kids are grown up and gone, right, out of college, financially free themselves, not financially free, but financially independent on their own, right? They have jobs. That their end goal number may be just 2 million, right? At that point. So I would say, you need to think about where you are on that spectrum. Now, for some of our investors in our family office group over 4 million net worth, you may not want to be investing in value add alternative investments. Maybe you do, for the tax benefits, but at that point, you're probably not working your day job and you don't have that high ordinary income where you need the losses from real estate in conjunction with rep status. So you're more in a different needs there. And some of the people, and we're going to be having a breakout session on Saturday in our retreat for some of these people, kind of discussing these strategies using security backed line of credits, finding the dividend stocks and that, and using it in conjunction with their alternative investment portfolio. But for the vast majority of people in our group, you guys are still in the growth years. Maybe not necessarily under $1.5 million, $2 million net worth, but you still need to grow it to that critical mass number to get that 10, 15 to $20,000 of passive income every single month. So if you're in that stage, and in a way, I'm kind of still in that stage myself, right? I'm not looking to kind of do nothing at this point. I've kind of found renewed energy doing this wealth elevator, kind of helping investors along this path as I did. But I'm still young and want to get after it, right? I'm still diligent. I'm not kind of gray hair, just rocking my nuts, do nothing type of attitude yet. Not say that I won't change, right, in the next decade. Who knows, right? But as you've already kind of seen, I think deal flow will change in 2024 for our investor group as opposed to what I maybe would have done in my 20s, where we would be kind of after it, in terms of more aggressive plays. But that's where investors in this growth stage should be, to put a number on it, yeah, at least 20 to 30% alternative investments is a number I think you need to get to. Just take my journey. In 2007, I graduated college and bought rental properties pretty early. But 5 years after college, when my net worth was under $500,000, I mean, I had maybe 50% of my net worth in rental properties, alternative assets. And then I increased it from there. There was a point where I was like, yeah, screw this stock market 401k stuff. It's just not working. I'm not getting the tax benefits from it, nor am I getting the returns from it. And so from 2000 and 13, 14, 15, 16 beyond, I withdraw the 401k and I went from maybe 50% alternative assets to 100% alternative assets. And we saw what happened, right? Like it worked for me. And that's why I believe in it. And obviously when, I became more of an accredited investor, I put a little bit in infinite banking. When I mean a little bit, maybe 10% of my net worth is in infinite banking and life insurance. But I am still very heavy in alternative investments, 80, 90% plus, I would assume. And that's in a way, it's kind of like, use that sailboat analogy. I have my sails up. I'm catching the market. I'm catching, I'm, some could say you're exposed, but hey, I'm still in growth mode and live and die by it. That's where I'm at. Now the transition happens once you feel like you're getting there, you're getting enough. And I feel like this happens, at least seeing like we do like hot seats within our mastermind group. I sit there and I kind of just observe and I get a lot more in-depth detail what people are doing in their portfolio, see all the holdings and where they are. It seems like when you get around 2.5 million net worth is when you start to come down on that roller coaster a little bit and you start to titrate back down a little bit from alternative investments. But until there, like you need to have the sales full up, I think. And yeah, sure, you combine this with when people are getting into this world, buying rental properties or in their first several syndication deals, it's going to be small. And I get it. And I think that's great, right? I'm all for like small baby steps, small wins I think is great. But make no mistake, if your net worth is $1.4 million right now and you want to grow conservatively to hit financial freedom before your 55th birthday, you're going to need to ratchet that alternative investment sucker up, that needle, to at least 20, 30%, maybe even over 50, 60%. And until you have, until you're balling and you got, multiple seven figures, multiple million, to be able to, bring the sales down a little bit to some extent and go for more of the conservative side. So I think that's where it's super important to find your specific peer group. Like when we do the retreat, we always try to, make everybody meet everybody. But at the end of the networking and the sessions, I kind of specifically try to break people out in their net worth ranges. I call it cattle grading because I used to work for the railroad and that was kind of the crude way of saying it. But ultimately, you need to find people that you follow this journey with, right? When you go from 1 million to 1.5 million to 2, and then 5 years later, when you guys have a little bit more gray hairs, you kind of both make the graceful exit from these alternative investments, and you go into some of the more advanced finishing strategies that we have. So without that peer group, I see some people who have $10 million and are investing like a kid who has $1 million investing in all these deals. And that's, I think that's just lack of calibration and self-awareness. And most times it's vice versa. A guy who has $1.5 million net worth investing like in gold and something. What the heck are you investing in gold? That thing doesn't do anything. That's what you do when you have multiple $1 million and you just need to have it just sit there and just sit there in gold is the saying, right? That's why they say it. Gold doesn't really increase in value, nor does it give you any tax benefits. You probably just got duped by some online influencer telling you to buy through their gold affiliate link so they can get commissions off of that. You know, but I think that's where it's important to kind of hear it multiple places. Like I say it, I think it's good to have some open dialogue on these types of calls that we do here. But you don't really replace, having you are the average of the 5 people you hang out with most, and that's where it's important to have that band of brothers around you. But with that, we've kind of hit the top. I've got to actually jump to a meeting here. It's kind of a busy Saturday and a busy Sunday once again out here. But yeah, thanks all you guys for coming. We do the office hours every first Saturday of the month. And then for those of you guys who want to get a little bit more specific into syndication, due diligence, and a little bit more academic approach to, the calls, we go through the syndication e-course for you guys. We do make it more of an open dialogue, so you guys get to ask live questions. I mean, that's kind of the whole point of it. That's the second or the third Saturday of every month. Unfortunately, we're not having it this month because I'll be in Atlanta in a tax seminar learning about some cool tax strategies there. But in February, we'll pick it back up on that cadence. But if you guys need anything, get your 2024 year started. Do know that this is the long game, guys. Like, this is not the get rich quick things. There will be ups and downs. There'll probably be more ups than downs, but I think that's where our community, I think, is very strong in that, offering that assistance. And I'm just here much to help you guys out, as also, you guys provide some nice camaraderie on my journey myself. But yeah, we got some interesting, fun things coming up, especially in the years ahead. I'm definitely, been talking to a lot of other people I wouldn't have in years past in terms of deal flow. So some exciting things I think that are coming out. But outside of the world of real estate, but inside of the world of real estate, yeah, you're going to see some stuff come out later on this month. So make sure you guys fill out that survey to ultimately guide where we place capital as a group, and then be on the lookout for that. If you haven't yet, make sure you're on the list. Some of you guys click the buttons to, or it lands in the spam box. I do send out a weekly newsletter with some things I've been seeing in the news. If you guys don't want that, let us know. And you just want the deals, let us know. We can kind of change your email subscriptions there. But if you're not part of that, go to thewealthelevator.com/club, and we'll see you guys next time.